There's a number of signs that economists and analysts use to attempt and estimate when a recession is going to strike. There are many of these, and a good number of them are good for getting a sense for the economy. But in general, they are not very trustworthy. The inversion of the yield curve is one of the indicators that has proven to be quite dependable for economists over the past 50 years. Over the past several weeks, this topic has received some attention from the general public, particularly among those who have an interest in the business world. Every time that this yield curve has inverted over the past 50 years, a recession has followed, providing a 100% hit rate for this indicator's ability to anticipate future economic downturns. This indicator predicted each of the last 6 recessions. Let's take a look at this graph, which will take us in 1876 and goes all the way up to 1976. An inversion occurred in August of 1978. An inversion occurs when the graph falls below the vertical black line that represents 0 and the yields on 10-year treasuries are lower than the yields on 2-year treasuries. Today, we'll discuss the significance of why this is the case and is important to talk about. Welcome to Smart Stock Academy, where you'll discover videos about businesses and insights from your prominent CEOs. Thank you for joining us for today's video, and let's explore topics that will awaken your curiosity when it comes to stocks and investments. Make sure to like, share, subscribe, and click that notification bell to assure you that you'll be updated whenever we upload videos. In any case, 16 months after the inversion, which occurred in January 1980, the Volcker recession occurred. In the middle of August in 1980, the yield curve inverted itself again after it had previously uninverted itself. After another 11 months, in July of 1981, a recession began. After that, the yield curve returns to its regular shape, and there is not another economic downturn for the subsequent roughly 10 years. But then December of 1988 rolls around, and we witness the terrifying yield curve inversion for the first time. Therefore, 19 months later in July 1990, there was a minor economic downturn that occurred. Once more, the exact same thing takes place in January of 2000, just before the collapse of the technological bubble, inversion of the yield curve, which again occurred in 2008, just before the global financial crisis. Inversion of the yield curve, which of course took place not too long ago and just before the pandemic in 2019, when the yield curve inverted. This inversion is disruptive and what would appear to be a reliable tendency of foreshadowing economic downturns. Now, the reason why we feel that this is important for us to discuss today is simply because we are certain that some of you are already informed of this, also because of the news. The yield curve has just recently inverted, which means that it has dropped below the zero line, leaving all economists and investors scared that a recession is on the horizon. Therefore, the questions that need to be answered are: will it arrive? How soon will it arrive? And what measures should we take to prepare for it? In today's video, we are going to go over all of these topics in detail. Given that the yield curve has now inverted, how much time do we have left? And what have the statistics revealed to us? Just looking at the last 6 recessions, the smallest amount of time that passed between the yield curve inverting and the economic downturn was 6 months. The most recent recession, along with the pandemic recession that took place in 2020, was the one that lasted the shortest amount of time. The Great Financial Crisis was the one that lasted the longest, as it took 24 months between the inversion and the recession. Therefore, the time span between the economic inversion and the subsequent recession might range anywhere from 6 to 24 months. The typical length of a recession is 14.8 months, which brings us to a point just beyond the milestone of 1 year. According to Arturo Estrella, a former economist at the New York Federal Reserve, and the most accurate predictions can be made approximately 1 year in advance, possibly a year and a half to a year. In light of the fact that the yield curve has turned negative, we still have a respectable amount of time until we enter a recession if we look to history for guidance. Keep in mind that looking to the past for clues about the future is not 100% reliable, but it can provide us with some basic pointers. What exactly is meant by the term yield curve, and crucially, why is it such an accurate indicator of the upcoming direction of the economy? First and foremost, when people refer to the yield curve, they are speaking about the yield curve for US Treasuries. The Treasury is the department of the government that is in charge of finances, and when they need funds, they loan it in the form of treasuries. Treasury is an abbreviation for the Department of the Treasury. This bond can be purchased from the Treasury by virtually anyone, and in exchange, the buyer will receive a yield. The time period for which this bond can be held can span anywhere from 3 months to 30 years. The government will take your money, utilize it for whatever purposes they see fit, pay you interest on it, and then return your original investment to you. After a specific amount of time has passed, it is common practice that the longer the period equals, the larger of yield you get. This is because you are subjecting your money to a greater degree of risk by investing it for a longer length of time. It goes without saying that you would like to profit more from this endeavor. On the other hand, when there is a great deal of unpredictability and panic in the market, the yield curve frequently inverts. That is to say, the longer you keep your money stored up, the lower the return on investment will be. The reason for this is that investors are so concerned about the near future that in order to hold short-term securities, they require a high yield. Additionally, they are willing to settle for a lower income in exchange for the security of having their money set aside for a longer time. We saw that over the course of the previous 6 recessions, this indication was correct each and every time. But before we do that, let's go even further back, because over the course of its much lengthier existence, it has not exactly been 100% of the time. According to the information that we have, if we go all the way back to the year 1900s, of the 28 instances of a yield curve inversion that have occurred over the course of the past 120 years, there have been 22 of them that were followed by a recession. Therefore, 22 out of 28 is a 78% accuracy. This section contains a graph that dates all the way back to 1929. Some of the contents of this data include the following: a cluster of economic downturns that began in the 1930s and continued until the 1950s. During this time period, there were no inversions, which is an intriguing fact that you will note. To summarize, you should be aware that an inversion of the yield curve is not a prerequisite of the occurrence of a recession. When it has, however, inverted, virtually every instance since 1921 has been followed by a period of economic downturn. Therefore, it was inverted during the Great Depression of 1929. The one that occurred in 1958 was an inversion. Another example of a previous economic inversion is the recession that lasted from 1960 to 1961. An inversion of the yield curve occurred just before each subsequent recession. In addition, the curve uninverts itself just before recessions the majority of the time. As a result, you can observe that the curve began to reverse itself around the year 1990, well before we experienced a recession. Before the economic downturn in 2000, it turned positive again, and in 2007, it was the same. Before the economic downturn, there was a reversal of the inversion pattern. Even if there has been a recent inversion of the major yield curve, many prominent economists are claiming that this time it will be different. They have their own primary motivations for doing so. Investors in the market claim that there is no need to fear about the inversion because it is being managed by the Federal Reserve. This is one of the reasons why the inversion has occurred. The Federal Reserve has been buying a lot of Treasury bonds recently. Since March of this year, the Fed has made purchases of Treasuries worth $3.26 trillion. $1 trillion have had maturities ranging from 5 to 10 years, and $1.4 trillion have had maturities of 10 years or longer. According to the experts, the Federal Reserve is actively influencing the bond market in the hopes that things would turn out differently this time and that another economic downturn will be avoided. Nevertheless, the issue is that financial experts were all stating the same thing, which is that things will be different this time in 2019 when it inverted. After the inversion in 2019, everything went back to normal. But in February of 2020, the world entered a pandemic recession. This is something that everyone is aware of. It's possible that they're right when they declare that this time is different, but statistics show that when individuals make claims like that, they're usually wrong. Keep in mind that the yield spread on the 10-year bond minus the yield spread on the 2-year bond is the one that just flipped, and that this spread is one that many analysts regard to be the most important to take note. But before we do that, let's take a closer look at all of the yield spreads. This should hopefully give us a clearer idea of what the bond market as a whole is trying to convey to us. To begin, let's look at the figure of the 10-year minus. the 1 year in which the trend has not yet reversed but which is moving in that direction. The difference between the 30-year and 10-year yields, which still hasn't reversed, but this one is very close to doing so. And finally, we have the 30-year minus the 5-year moving average, which has reversed direction and moved into negative territory. When compared to a bond with a term of 5 years, a bond with 30 years has a lower yield. The 10-year Treasury yield minus the 3-month Treasury yield is the only curve that moves in the opposite direction of the others. In other words, the slope of this curve has been climbing steadily higher over the last year. Because it is nowhere near inverting, this shows us that bondholders are content with getting lower yields on 3-month treasuries. Many market experts consider the yield spread between 3 months and 10 years to be a more reliable indicator of when the economy would contract. Noting that the curve has not flattened suggests that the economy may be alright for the time being. Let's review all that has been said. We witnessed an inversion of the yield curve. In the past, this has served as a somewhat reliable forecast of economic downturns. On the other hand, after an inversion, it might take anywhere from 6 to 24 months for the economy to officially enter a recession. Therefore, it appears that we still have time on our hands. Historically, the months and quarters that followed an inversion in the market for stocks and shares of ownership tended to provide some of the highest returns. Therefore, it's possible that in the near future everything will go smoothly and the market may even go up. That's it for today's video. Let us know what you think and leave it in the comment section so we'll know what your insights are. Again, make sure to like, share, subscribe, and click the notification bell for more updated videos about the business world.